Geopolitical tensions will not have a lasting impact on energy prices. That's according to the CEO of Shell, Peter Vosa, who was speaking on the sidelines of the China Development Forum in Beijing. The head of the Anglo-Dutch oil major also stressed that the industry needs new investments to meet growing crude oil demand.
These volatilities are short, medium term. I think in the longer term, we will get back to normal market-driven pricing, which is really a supply-demand function. And there, I think, longer term, you will see demand rising, and therefore we need all the investments to actually cope with that demand. Now, in the very long term, we see energy prices growing up. A, there's high demand, and B, it's getting more expensive to actually produce the barrels, so the resources are more complex, and it just costs more to get them out of the ground.
And joining us now to talk more about the energy markets and oil prices is Robert Brusca, Chief Economist at FAO Economics. Robert, great to have you on the program. Thank you so much for joining us this morning. Let's talk generally about prices first and a little bit about the direction and momentum we're seeing. Obviously, in the sound that we just heard there, the CEO of Shell expecting prices to continue to rise. Is that your take as well?
Yes, we have a big change in the world economy with all of these developing economies that are large. China is a really big place. So this really makes the oil game a lot different than the last time we had an oil price spike, where the prices went up and they became so high that people eventually began to react to it and they began to conserve, and demand was lower and prices went down. But now, while that same effect is still in place, we have all these new consumers that keep coming online, and they keeping the price from falling. And so whenever anybody has a longer outlook for where we're going to go, they recognize that we're underpinned by this growing demand from new sources, and that keeps oil prices from really falling sharply, even though the relative price of oil has risen so very much.
That's a great point and very, very interesting. But let's also talk about some of the geopolitical risks in the marketplace right now. Obviously, tensions in the Middle East, a big issue, and certainly haven't been taken off the table just yet. Could we see tensions this summer escalate to a point where the U.S. consumer sees gas at, say, $5 a gallon?
I don't think you can take any price off the table where the Middle East is concerned. There's a real problem there. It's a very important place for oil. The Saudis right now are in the midst of a program to really pump out and ship a lot of oil to try to drive these prices down close to $100 a barrel. But so if anything were to happen to constrain the Straits of Hormuz or to really escalate tensions in that area, you could see oil going to levels that would be astronomical.
Robert, this is John Sylvia, Wells Fargo in London, and good to see you again. An interesting aspect of the American consumer today, Robert, is the argument that I see from time to time that, yes, gas prices are up, but natural gas prices, heating prices are actually down. So how does the American consumer balance these two very different trends in terms of energy?
Well, as long as you have two completely different furnaces in your home, you can switch between one and the other when it gets cheaper. I myself don't know anybody who's in that circumstance. Over long periods of time, of course, people can switch from the expensive fuel to the cheap one, and that's what is there for the longer run. But in the short run, people are stuck with the mode of heating that they have, and if oil prices go up, they'll have to take care of that. And if they decide to switch over to gas in the future, apparently they'll be able to do that. So I don't think it's a short-run issue, but there are more people who are using broader energy sources than they were in the first oil shock, and this has helped to keep the damage, I think, this time a little bit contained. But in the short run, you're stuck with the fuel source that you're using.
Robert, I'm just wondering what the impact of slowing demand from countries like China and India will be. Increasingly, they're weaning off the public from subsidies and raising retail fuel prices to the highest ever.
Well, I think even in countries that have traditionally subsidized energy, you're going to see that become more of a problem. And of course, what it means is for people in these countries, the relative price of energy will be higher. It means that they'll be thinking twice about expanding into fuel use. But their demands are still going to grow because we're having a growing standard of living in these countries. We're drawing more people into the modern economy. And so when we look at the impact on the global oil market, it's going to be more demand.
All right, fantastic, Robert. And just last but not least, we have seen a correlation in the past between fuel prices and approval ratings for presidential candidates. And certainly we're seeing that again this time around. It's tough for Barack Obama to be able to overcome this, yes?
Well, I think that the gas prices are right now his nemesis, but economic growth has been his tailwind, and so he's got a couple of forces in play that are helping him and hurting him.
Positive. Okay, thank you so much, Robert, for joining us. Of course, Robert Brusca, Chief Economist at FAO Economics.